China just went on an 18-month gold buying binge, the truth leaked. For 18 months, one nation has been moving in near silence. While the world watched gold's price fall, while headlines called it weakness, while traders rushed to sell, China was doing the exact opposite, quietly, methodically, without explanation. Reserves climbing, imports surging, banks raising walls around their own gold markets. And then, something changed. Internal data leaked, numbers that were never meant to reach public eyes. Numbers that reveal not panic, but a plan. A plan 18 months in the making. And what it suggests is not a market correction. It is a warning. A warning for every economy still measuring wealth the old way. Because by the time this becomes common knowledge, the window to act on it may already be closed. What China knows, the rest of the world is only now beginning to see. Now, if there is someone watching this who has lived through enough economic cycles to know when something feels different, someone who remembers what gold meant before headlines tried to explain it away, we would be honored if you considered subscribing. Not for algorithms, not for numbers, but because wisdom like yours deserves a place where these conversations are taken seriously. And we would love to know, where in the world are you watching this from today? Let us know in the comments below. Now, let's uncover what China has been hiding. In the spring of 2026, something strange was happening in the world of gold. The price was falling. Analysts were calling it weakness. Traders were stepping back. And yet, while the headlines spoke of decline, one nation was quietly doing the opposite. China was buying more gold than it had in years. This was not a small detail. It was a contradiction that very few people stopped to question. If gold was truly weak, why would the world's most disciplined economic planner be accumulating it at a pace not seen in more than 2 years? The answer, as it turns out, was not weakness at all, it was strategy. To understand why this matters, one must first understand how China operates. Unlike many Western economies, China rarely acts on impulse. Its central bank does not chase short-term price swings, does not panic when markets dip. Instead, it moves with patience, and it moves with purpose. So when the data showed a sudden surge in gold imports, business analysts around the world paused. Something was shifting beneath the surface. The numbers told a clear story. In a single month, China's gold imports reached levels not seen in over 2 years. Across the first 5 months of 2026, the total volume of gold entering the country had grown by more than 70% compared to the year before. This was not a minor increase. It was a clear and deliberate acceleration. What made this even more puzzling was the timing. Officially, China's central bank reported only a modest increase in its gold reserves that same month. On paper, the institution appeared cautious. But the import data told a very different story. If the central bank was buying so little, where was all this gold actually going? This is the question that troubled many observers. Some pointed to private demand. Wealthy individuals and households across China have long viewed gold as a safe place to store value, especially during uncertain times. Others pointed to new financial products that allow ordinary people to buy small amounts of gold gradually, almost like a savings plan. Both explanations were partly true, but neither one fully explained the scale of what was happening. There was something else at play, a deeper pattern, one that pointed not just to individual behavior, but to a coordinated, almost invisible accumulation taking place at a much larger level, the kind of accumulation that does not show up clearly in official statements, but does show up in trade data, in reserve levels, and in the quiet movement of physical metal across borders. For 18 months, this pattern had been building, slowly, steadily, without dramatic announcements. While the rest of the world focused on daily price charts, China appeared to be focused on something else entirely, building a foundation. A foundation made not of currency, but of something older, something harder to manipulate, and something far more difficult to print into existence. This is where the story becomes important for anyone paying attention to the global economy, not just gold investors. Because what a major economic power chooses to hold in large and growing quantities often tells a story long before it becomes obvious to everyone else. Gold has historically served as a hedge against currency weakness, against inflation, and against uncertainty in financial systems. When a nation accumulates it aggressively, especially while publicly downplaying that accumulation, it raises a serious question. What does China know that the rest of the world has not yet fully understood? This single question sits at the center of everything that follows. It is not a question about gold prices alone. It is a question about confidence, about trust in paper currencies, and about how the world's second largest economy is quietly preparing itself for a future it expects to look very different from the present. In the chapters ahead, this pattern will be examined piece by piece. The import data will be unpacked. The gap between official numbers and real activity will be explained. And the second major event, a sharp move by Chinese banks to make gold trading more difficult for outsiders, will be brought into focus. Together, these two events do not simply describe a market trend. They describe a strategy. And for business leaders, investors, and decision makers watching from the outside, understanding this strategy may prove far more valuable than watching the daily price of gold ever could. The surface shows a falling price. Beneath it, something else is being built. To understand the true size of what China has been doing, one must look past the headlines and into the customs records. These are not opinions or predictions. They are hard numbers, recorded at the border, every time gold physically enters the country. And in recent months, those numbers have told a story that very few people expected. In one single month, China brought in more gold than it had in any month over the past 2 years. The figure stood at roughly 163 tons. To put that in perspective, that is enough metal to fill a small warehouse moved across borders in just 30 days. And this was not an isolated spike. Across the first 5 months of 2026, total imports reached close to 700 tons, a jump of more than 70% compared to the same period the year before. Numbers like these do not happen by accident. They happen because someone, somewhere, made a decision to acquire gold on a massive scale. The real mystery was not whether this was happening. The trade data made that undeniable. The real mystery was who exactly was buying and why the buying was happening so quietly. This is where the story becomes more layered. According to official statements, China's central bank only added a small amount to its reserves that same month, a modest figure compared to the import surge. On paper, this looked like restraint, but restraint does not explain hundreds of tons of gold entering the country. If the central bank was not absorbing all of it, then something else was happening behind the scenes. Some analysts pointed to the rise of new gold buying programs aimed at everyday citizens. These programs allow people to purchase small amounts of gold regularly, almost like building a savings account, but in metal instead of cash. This kind of product has become increasingly popular across China, especially among people who no longer fully trust paper savings to protect their wealth over time. It is a quiet form of self-protection, repeated by millions of individuals month after month. Others pointed to demand for physical bars, the kind bought not for trading, but for holding. Bars that do not move once purchased. Bars that disappear from the market and into private vaults, drawers, and family safes, never to be sold again in the short term. This kind of demand does not show up as dramatic news. It shows up only when someone studies the trade data closely enough to notice the pattern. Yet there was a third explanation, one far less visible than the other two. Around the same time, China introduced a new licensing system for gold imports, a system that gave central banks fewer restrictions when it came to moving gold across borders. This change did not make headlines outside of specialist financial circles, but for those paying close attention, it suggested something important. If access was becoming easier for central banks specifically, then perhaps a portion of this surge was not driven by households or investors at all. Perhaps it was driven by the state itself, moving carefully, using old rules before new ones replaced them, and avoiding the kind of attention that comes with sudden, obvious action. This detail matters because it changes the entire picture. It suggests that what looked like a private buying spree may have also included a much larger, quieter form of accumulation, one carried out at the institutional level, deliberately kept out of the spotlight. There's also more unusual detail buried in the data. Even as imports surged, withdrawals of physical gold from the country's main gold exchange dropped to their lowest level since the early pandemic years. In simple terms, gold was coming into the country in large amounts, but very little of it was being pulled out of storage and circulated. It was coming in, and it was staying in, almost as if it were being collected and held rather than traded. When import volumes rise sharply, official buying appears modest, and physical withdrawals fall to multi-year lows, the explanation cannot be only individual demand. It points toward something far more deliberate, a system designed to accumulate without announcing, a pattern building quietly beneath official statements. This is the foundation of the 18-month story. Not one single event, but a slow, layered accumulation, hidden in plain sight within trade data that most people never read. What happens next builds directly on this foundation, as a second and even more telling move begins to take shape inside China's own financial markets. While the world was still trying to understand the import numbers, a second event was quietly unfolding inside China's financial system. This one did not involve gold crossing borders. It involved gold being traded within the country, and the rules around that trading were suddenly changing in a way that caught serious analysts off guard. On a specific day in late June, several major Chinese banks raised the trading margins on gold contracts traded on the Shanghai Gold Exchange. Some of these margins rose to between 120 and 140%. To understand why this matters, one needs to understand what a margin actually is. A margin is the amount of money a trader must set aside before they are allowed to enter a trade. A higher margin means a trader needs more money up front just to participate. What made this move unusual was the size of the increase. These new margins were placed on top of requirements that already existed on the exchange itself, requirements that range from 15 to 25%. When combined, the total cost of entering certain gold trades became far higher than before. In practical terms, this meant that traders were now being asked to put up more money than the actual value of the contract they wanted to trade. This is not a small technical adjustment. It is a deliberate barrier. When a financial institution makes it significantly more expensive to speculate on an asset, it is sending a clear message. It does not want short-term traders moving in and out of that asset casually. It wants to control who participates and at what cost. The timing made this even more significant. This decision came directly after a period where global gold prices had dropped sharply, falling more than 12% over the previous month. In a normal market, a price drop like this often attracts opportunistic buyers, people looking to take advantage of lower prices. By raising margins at this exact moment, Chinese banks made it harder for that kind of opportunistic buying to happen freely. One possible explanation is straightforward market protection, an attempt to reduce excessive speculation during a volatile period. But there is a second explanation that carries far more weight when placed next to everything happening in Part 2. If a nation is working to accumulate large amounts of gold quietly, the last thing it would want is a flood of independent traders entering the market and driving prices upward before that accumulation is complete. Raising the cost of trading achieves the opposite. It cools outside participation while accumulation continues in the background. This pattern becomes even more meaningful when placed alongside China's foreign exchange reserves, which climbed to their highest level since the end of 2015, surpassing $3.4 trillion. A nation does not casually raise its reserves to multi-year highs while also restricting access to a key asset, without some larger purpose in mind. These are not isolated decisions. They appear to be connected pieces of a broader financial strategy. There's also a longer-term ambition tied to this moment, one that goes beyond gold itself. China has been working steadily to expand the international use of its own currency, the Renminbi, in global trade, strengthening domestic control over gold markets while simultaneously growing foreign currency reserves fits naturally into that ambition. Gold has always served as a foundation of trust in financial systems. A nation that wants its currency to be taken more seriously on the world stage benefits from having a stronger, more controlled gold position behind it. What emerges from this is not a story about ordinary market regulation. It is a story about construction. The construction of a financial wall around a strategic asset built quietly, using technical rules that most outside observers would never think twice about. Two events, the import surge and the margin wall, no longer look separate when examined together. They look like two parts of the same plan, each one reinforcing the other. What this plan signals for the rest of the world is where the story turns next. You said, now move to the final part. 400 to 600 words. When two events happen at the same time, it is easy to treat them as unrelated. A surge in gold imports, a sharp rise in trading margins. On their own, each could be explained away. Together, they form a pattern that is much harder to dismiss. Consider what each piece reveals. Gold has been flowing into the country at a pace not seen in years. At the same time, the ability to trade that gold freely within the country has become more restricted. Imports rising, while access tightens, is not the behavior of a market reacting to weak demand. It is the behavior of a system designed to gather an asset quietly, while limiting outside interference in the process. There is one detail that supports this interpretation more than any other. Throughout this entire period, while prices fell and global investors grew nervous, there is no clear evidence that China's central bank sold any meaningful amount of its gold reserves. 18 consecutive months of purchases, even if the pace varied from month to month, tell a simple story. The buying continued. It did not reverse. This matters because selling is usually the first sign of doubt. When an institution loses confidence in an asset, it reduces its position. It protects itself by stepping back. The complete absence of selling, even during a period of falling prices, suggests something closer to conviction than concern. It suggests that the recent price weakness was viewed, internally, as an opportunity rather than a warning. This pattern is not new in financial history. Long-term holders who continue accumulating during periods of public pessimism are often acting on a longer time horizon than the rest of the market. They are not focused on this week's price movement. They are focused on where they expect value to sit years from now. When that kind of holder refuses to sell, even under pressure, it often signals that a price floor is being formed beneath the surface, even if the broader market has not recognized it yet. For business leaders, investors, and decision makers, this pattern carries a lesson that goes beyond gold itself. It is a reminder that the most important economic signals are rarely loud. They do not arrive as breaking news. They arrive quietly, buried inside trade data, regulatory filings, and reserve reports that most people never read closely. By the time a pattern like this becomes common knowledge, the early advantage of understanding it has usually already passed to those who were paying attention first. This is the core warning at the center of the entire story. The public narrative focused on a falling price, framing it as weakness. The underlying data told a different story, one of steady, deliberate accumulation taking place beneath that falling price. These two stories cannot both be true in the way they were presented, and when they conflict, it is almost always the quieter, harder-to-see story that proves more accurate over time. China's actions over the past 18 months do not prove with certainty what will happen next in global markets. No single pattern ever does. But they do reveal something important about how a major economic power positions itself when it expects future uncertainty, currency pressure, or shifts in global trust to increase. The surface showed a falling price. Beneath it, a foundation was being built, 1 ton, 1 contract, and 1 quiet decision at a time. What remains uncertain is not whether this foundation exists. It is how long the rest of the world will continue looking only at the surface before recognizing what has already been built beneath it.